Welcome back to the Wealth Planning Podcast with Brister Law. Up until this point in the series, we focused on how to reduce taxes through structure and real estate. But today we're going to be shifting from tax reduction to control of your wealth, because saving taxes this year is good, but building future income that the IRS has limited access to is better. This episode is about solo 401ks, Roth conversions, HSAs, and HRAs, security-backed line of credit, and how wealthy families think about liquidity without selling assets. Most people make money in taxable buckets, but we want to build money in protected buckets. Most people obsess over rates of return, but very few people design how their money will be taxed. And the tax code rewards people who choose the right containers, control timing, and separate accumulation from distribution. At a high level, money lives in one of three places: taxable now and later, tax deductible now, taxable later, and tax advantage now and tax-free later. Our job is not to avoid taxes entirely. Our job is to intentionally choose which bucket gets filled next. If you're self-employed or you own a business with no full-time W-2 employees outside of yourself and your spouse, then the solo 401k is almost the best retirement tool available. And why? Well, it's because you get to contribute as the employee and the employer, and this allows a significantly higher contribution than an IRA or a SEP alone. You can also layer in Roth contributions, which mean tax deductions today for some dollars and tax-free growth and distribution for others. Solo 401ks are about control, and control is what wealthy planning is actually about. Next, let's talk about a Roth conversion. And a Roth conversion is not a tax deduction play, it's a tax arbitrage play. You willingly pay tax today, so you never pay tax on that money again. And used correctly, Roth conversions reduce future required minimum distributions, they create tax-free inheritance, and they hedge against rising tax rates. The biggest mistake is converting too much at once. You want to look at your current income, bracket ceilings, and future income trajectories. And then you convert only enough to stay inside a planned bracket. This is not aggressive, it's being deliberate. Another great tool are health savings accounts, and they're one of the most misunderstood tools in the tax code. HSAs offer a deduction when the money goes in. They offer tax-free growth and tax-free withdrawals for qualified medical expenses. That's a triple tax advantage, and very few accounts do all three of these. When possible, this strategy is not to spend the HSA every year. It is to let the HSA function as a long-term medical reserve. And then later in life, medical costs rise. That's when this bucket shines. Now, for business owners, HRAs or a health reimbursement account allow reimbursement of qualified medical expenses through the business in a documented and compliant way. This can convert expenses that are otherwise non-deductible into business deductions. Now, HRAs aren't a DIY strategy. They require design and compliance, but when you use it properly, they close one of the biggest tax gaps that business owners face. Another great tool that I see clients use is a security-based line of credit, and it allows you to borrow against investments instead of selling them. The benefit is really simple. You don't sell assets, you don't have capital gains, and you do not disrupt compounding. This strategy is about leverage, not gambling, and it's about liquidity control. We see wealthy families use S-blocks for short-term cash needs, strategic purchases, and opportunities where selling assets would not be tax efficient. Borrowing should always be measured though, but borrowing instead of selling can dramatically change your tax outcome. And if you're earning well but still feel boxed into taxable income, the issue is not income, it's about your container design. And if you want help designing how your money flows over the next 10 years, schedule a strategy session with our firm at bristertaxable.com. In the next episode, we're going to be closing the series with advanced year-end strategies that stack on top of everything that we've discussed. Thanks for watching. If you found this helpful, go ahead and give it a thumbs up, drop a comment below, and if you have any questions or thoughts, I always try to respond. And if you haven't already, hit that subscribe button, ring that bell so you don't miss out on the next video. And if you want to go deeper or grab the resources that I mentioned, check the description below. I've got all the links, tools, and next steps for you there. And if you're ready to talk about your specific situation, you can also schedule a free discovery call using the link in the description. Just pick a time that works for you best. And if you know someone who could benefit from this, feel free to share it with them. It really helps spread the word.